The ExxonMobil losing streak continues, the stock falling in 20 of the last 21 trading sessions. Exxon, along with Chevron, have accounted for about 1/3 of the Dow's point losses this month. Exxon fell fractionally today to close at $86.42. Shares are down more than 9% since the end of July.
So what's going on with these two oil giants, Exxon and Chevron, especially with energy prices so very high? Here to tell us why is Pavel Molchanov. He's an energy analyst with Raymond James. Pavel, welcome. Good to have you with us. Why are these two shares struggling so much?
Sure. I mean, several reasons. One is very simple. Until maybe the last week or so, we've been in a bull market for equities. Exxon and Chevron are inherently defensive stocks. They are simply not in favor in the context of a bull market where investors generally want something more growthy, higher beta, more speculative. This is the very opposite of high beta or speculative. Second reason is, refining stocks have also been very weak lately because the spread between the price of Brent crude and WTI has compressed. And remember, we think of Exxon and Chevron as oil producers, and for the most part they are, but they also have a big U.S. refining business which has suffered as those spreads have tightened. And then thirdly, yields have gone up, as we all know, and yield-bearing securities have generally traded off in that context. And both Exxon and Chevron are, high dividend yielding stocks, always have been.
Pavel, yet you have right now buy recommendations on both Chevron and Exxon. Is it because they've gotten so low that they have, good opportunities? What's the story there?
Yeah, I love these stocks here. I mean, they are, particularly if investors, as we do, believe that oil prices are going to soften into next year. We think there is quite a bit of downside to oil. And in the context of falling oil prices, it is precisely these kinds of high-quality defensive energy stocks that tend to outperform. Now, last 6 months, it's been the smaller cap, more higher beta, E&P independents, some of the service companies that have done better. And certainly we think there are opportunities in those sectors too. But these mega caps screen very well again, if in fact oil prices do soften into next year.
So if I own, as many of our viewers presumably do, Exxon as a core holding, maybe Chevron as a core holding, partly because they like the yield on those stocks, you would say definitively hold those stocks and maybe buy on weakness.
Yeah, we would absolutely be buyers on weakness. Again, if oil prices do weaken into next year, and the futures curve is telling us that, supply-demand analysis we've done tells us that, these stocks should do relatively better than most of the smaller, higher beta energy stocks.
So tell us about oil prices. You keep saying that if they go down, how much could they go down this year or next year? Right now, West Texas crude is $104 a barrel.
Yeah, well, we think that by the end of the year, it's going to be in the low to mid 90s, so down, 10%, maybe more. And then next year, we think WTI could potentially get into the 70s. Now, that depends obviously on a lot of factors. For example, right now, the price of oil is being propped up by Egypt, even though the Egyptian political crisis has absolutely nothing to do with oil supply whatsoever. So psychology has propped up the price because of the news flow on TV, but that's all it is. It's just a fear trade, pure sentiment.
All right, Pavel, thank you very much. Pavel Molchanov is an energy analyst at Raymond James.